What's the best way to trail your position with a protective stop? Is it percentage based or should you use the ATR? And the answer is yes. What does that mean? Well, it depends, right? If you're using percentage based, it's typically based on, ATR anyway. That's the way I would look at it. You could divide that into what your R is and then figure out the number of shares, number of contracts. I think the better question is maybe you want to use structure, right? That's probably a better question. And what happens if, the move starts to go up and there is no structure? So I think from my own trading, I use both and I go back and forth. If I'm in a name and it's working out and I want to add more, I could add more above structure. If it kind of channels sideways, put my buy stop in. Once I get filled, obviously I have to change my protective stop to account for the fact that I've got more inventory. And you can price your risk to be right below support. I'm not worried about what the ex-market makers used to say because most of that stuff is crystal ball stuff anyway. No one can really predict. Two, market makers don't necessarily want to own stuff that's going down, and that's what they'd be doing if they'd be hitting your stops. So I feel like that's the boogeyman. Two, to be frank, your job is to manage risk. You can't be worried about stuff that you can't control. And once you start putting in stops and limits, everybody in the world can see them. So what I would typically do when I start is think in terms of percent. And that's based on R, right? So say you got $1 million and you're risking 0.5%, you risk 5K. You could look at volatility for your position sizing, mechanism, and whatever that quotient would be the number of, contracts or shares. And, from that point, it's super simple because then, if it's based on the ATR, you use that to calculate the number of contracts or shares. You can see the breakout price, which is above the market, and then the ATR itself becomes where you place your protective stop. So it's super elegant mathematically, super clean. Not a lot of thought has to go into it. You could do it on a spreadsheet. I have one for you. You can email me if you want. It's super easy to put together. Future's a little trickier, but this is the beauty of it, is that you can normalize the risk across all the different contracts. Why? Because they all have different standardized sizes, right? So it's hard to, you need to figure out what's the dollar vol of the instrument. Some of you look at your positions and then figure out how much in a kind of can slim kind of way are you going to give it 8%, 9%, whatever it might be. I don't do it that way. I always take a look and figure out what is the risk that I'm willing to take for my own portfolio rather than the position. Then you look at the volatility, perhaps by ATR or standard deviation, to calculate what's the personality of the contract. That's kind of how I look at it. The ATR kind of tells you, like, normally, like what to expect from the underlying instrument. So that has to parlay into my R, like in what I'm willing to risk on a per trade basis. So there's an inverse relationship between volatility and position size, right? As the vol goes up, if you want constant risk, which I typically do, I don't try to get into hunches or things, although I'm very intuitive and impulsive in a good way. I think I kind of vacillate between using that percentage risk, and then as I adjust and the market shows me structure, then you could switch and look at support. Most of this stuff, though, is going to be case by case, right? Because you just might not prefer to do structure. You might want to always do it. So I would say do it however it feels. For me, myself, I think as the market activity unfolds, the Dutch auction process, it's a dynamic situation. And so a lot of times I'll be in positions and I'll trim, right? As the volatility expands, like if you look at even like the darling of the day, NVIDIA, and volatility's increased 33%. So you would have had to adjust your position sizes down, right, by as a percentage in order to keep that constant risk out there. And that's how I learned to sleep at night, as far as I'm concerned. I don't get hung up on, the specific sniper entries. That's not important to me. Heck, if you looked at half the stuff that I buy, you would look at me and think I'm an idiot. You probably might think that anyway. But in other words, there are names that have advanced quite a bit, maybe sometimes between 25 and 100% before I even start to add. Like, that's the appetizer. That's the warm-up, you see? Because I'm not looking to buy fallen angels or things that are down or things under, $10 a share. You might feel differently. I respect everyone's opinion. We're all really just sharing ideas here. I have the best way for me. I don't know it's the best way for everybody. That's why I don't sell trading system crap on the internet, because who the hell knows if it's going to resonate with you. It might be interesting to learn intellectually, but I think this work is much more important. So I don't know, in my experience, since I've used the ATR to calculate the percent, or work that into the percent of my account that I'm willing to risk. You might consider vacillating and going back and forth, seeing, where is there support, and in using that as you price in your stop. Because what ends up happening is, if you're going on a fixed dollar amount saying, I'm going to put on this trade, I'm looking at 1 minute bars, and I'm going to risk $2 per share, well, that's great. But, if it's still within a trading range, right, that could be $5, you could still get stopped out at $2 and kind of still be in an overall uptrend, although within a base. You see what I'm saying? And over the years, that would aggravate me. So I wouldn't try to trade the thing larger and need more impeccable timing. I would say, okay, here's the base. It could trade through, and that's happened before, and I get stopped and it kind of goes back up. But then I'm like, okay, well, I could just get the next breakout. Like I don't fall to pieces about that. So I think both are very, very legit. The key to me, if I can impart any wisdom to you, whether you're institutional or whether you're just starting out, is in order to know what your numbers are from an expected value standpoint, I would use a constant risk unit. And if it's $500, if it's $100, doesn't matter to me what the number is. It's all kind of congruent with where you are in your trading, how much capital you have under management. We're going to talk about that this week. And like what's an adequate amount of capital to need to start trading. We'll probably talk about that tomorrow. There is no one best way. It's really a feel play. Like I would get aggravated if I was smart enough or lucky enough to put myself in the right place at the right time and have my buy stop hit, usually letting the market come to me. I don't like chasing. And then using structure, I would make sure that it was a significant kind of line in the sand, whatever they're called, Maginot lines or whatever, and say, here's where I'm clearly on the wrong side of the trade, because I don't want to get wagged out of something by trading it too big, thinking I'm going to get cute. You see what I'm saying? So that's my 2 cents. If you like this video, check out this one.